Hello, how do I find stocks that pay dividend? Today we are going to look for dividend stocks, high-paying dividend stocks in the consumer discretionary sector, inside the specialty retail industry, and especially in the apparel retail sub-industry. So if you have Charles Schwab account, you are going to log into your Charles Schwab account. When you log into your Charles Schwab account, by default you will be under account summary. From there you will click on research and you will click on US market. When you do that, chances are it might give you the option to return to classic view. If you have that option, you might click on it. If you do not have that option, you will scroll down. And I believe I have the option here. You will just from that main page, instead of clicking on return to classic view, you'll just scroll down and you'll be able to find the sectors there. So, and you click on show more. So you scroll down to sector and click on show more, and you will be able to see them, and you will click on the one you want to work on. So today we are going to work on the consumer discretionary. We are going to continue working on that. So you will scroll down and click on industry. So we are going to look for industries. And when I'm looking for dividend stock, I like to work in the classic view because of the layout. And you can see you have the sectors. And you can just click on the one you want to look for dividend stock in. And today we are going to continue with consumer discretionary sector. And inside that, they have industries. We are going to pick one and we work on the one above in previous videos, and the link to the playlist will be in the description. So we'll click on specialty retail, and specialty retail has 135 companies. And from here, we will click on apparel retail. And as you can see, you have the SP 500 market, consumer discretionary sector, specialty retail industry. So we will click on apparel retail, and you can see under this sub industry, they have under this industry, specialty retail industry, they have multiple sub industries. And in this video, we are going to work on apparel retail. And under apparel retail, you'll find the companies. So apparel retail, all companies. And they have, you can even narrow them down by market capitalization. But it's not something we use as a criteria to select dividend stock. So we are not going to do that. We are just going to stay within all companies. So from this page, you will click on valuation, but I will just let you see the companies that are in these sub-industries. And first, let me wait few seconds. If you want to take a screenshot, you can do that. And our goal is just to select high paying dividend and record that on our investment spreadsheet. It does not mean the other companies that we are now going to include it are bad companies. It just does not meet our first requirement, which is finding dividend stocks to invest in. And we can scroll down a bit more for you to see what is out there. And it has 2 pages, so I can click on the second page for you to see that page as well. So now that you have an idea of the companies that are in the specialty retail sub-industry, let's go back to page 1. And under page 1, you'll click on valuations. By default, it is performance that will show up, and those are the criteria for performances, but we are going to work with valuation. So under valuation, you are looking for dividend yield. So when you click on it, it will sort it from the highest to the lowest for you. At this point, you want to set a dividend yield, annual dividend yield that you don't want to go under. And your choice might be different from mine. For instance, I have criteria that I work with, and the first criteria is 5% annual dividend upward trend that went public before 2000. There are multiple criteria here that we don't need just yet. 5% is what we are looking for. The second criteria is using 3%. The third one is using 6%. So that means for us, we want to select companies that are paying more, that are paying 3% or more in annual dividend yield. So depending on your goal, you might set a higher dividend yield to work with, and that's okay. And you might set a lower dividend yield to work with because of the companies that you are interested in. Because many good companies don't pay a high dividend yield. So that's something to consider. So we are going just to scroll down to see where that ends. And in this example, it's going to be up to 4.2%. So I'm just going to screenshot. That is going to be this one. So at this point, it's good to have an investment spreadsheet. And your investment spreadsheet will have, you can leave a column for dates, a column for the company's name, a column for the symbol, a column for the market the company sells on, a column for the price is selling currently, and that is something that changes. You wanted to have a column for dividend yield and a column for the chart trend. You wanted to have a column for 52 weeks low price, the lowest price and the highest price within 52 weeks range. You wanted to have column for it. You wanted to have a column for the sector, the industry, the sub-industry, and the year it went public. And it's good to have a column for the month of the quarter that it pays dividend as well. So when you have your spreadsheet design, then you go back and you copy from this page, you copy the name, you type the name of the companies and the symbol to your spreadsheet. That is the price this company, Caro Corp, is selling, and that is the annual dividend yield, 9.76%. So at this point, we use one criteria, dividend yield, 3% or more, and it allows us to downsize 2 pages into how many? 1, 2, 3, 4, 5, 6 stocks. So now you are going to apply the second criteria, and the second one will be to pay attention to the company's name. You are looking for companies ending with corp, corporation, inc, co, and that tells you that they are corporation. And what you want to avoid is LLC, SA, those ending, you want to avoid them, or PPL, or partnership, or partners, or companies that do not even have any entity taro at the end. Avoid them. If you have to think if they are a corporation or not, they are not worth your time just yet, because there are so many companies in the stock market that you don't need to do a lot of research to know the type of entity the company is at this point. So, and out of the 6 that we have, they all made a corporation entity taro in their company's name. Therefore, you will recall their names, their symbol, the price they are selling, which is underneath the name, and the dividend yield they are paying. So let's say that you are done with that. Now you will try to analyze the company, and I like to batch work this, but we are just going to focus on one sub-industry this time. But I just like to scroll down for you to see the other companies and how much they are paying in dividend. And we are looking for dividend stock. That's why we are not going to worry about the rest that are not meeting our requirement. So now that you select the companies that meet your criteria, you wanted to go analyze them. So you'll have the list of them on your spreadsheet, and what you'll do is you'll go back to your Charles Schwab account, and I'm going to click on menu here, and I'm going to click on research because I made a little bit. Let me see if I can make it a little bit smaller. So under research, you'll click on stocks. And it's because I'm trying to get out of the classic view to go to the default view. So when you are under the research stocks page, you will enter the first one you record on your spreadsheet. And at this point, I don't know if I have those sectors on my spreadsheet. So I'm not going to be working with my spreadsheet, but we are going to be working with our PowerPoint here. And let me see if I can find So we have 1, 2, 3, 4, 5, 6 here we can work with. Good. And while we are there, and the first one is CATO. So we are going to type it CATO, and when you type it, you want it to make sure you find the company's name and you click on it. Now you are going to analyze each company one by one. So from this page, you want it to complete your investment spreadsheet. You will first look at the stock market the company is selling on, and that is the third criteria. You want it to avoid OCT market, and therefore you want it to make sure it is sell on New York Stock Exchange market or NASDAQ. So those are the two that you wanted to accept on your spreadsheet. So if the list the companies you included on your spreadsheet, when you start analyzing each one of them, the third criteria, it doesn't meet your New York Exchange or NASDAQ market, then you do not continue completing your investment spreadsheet for that stocks. That means that stocks fail your next criteria, so it's out of the list. You don't necessarily need to take it out of your spreadsheet, you just don't continue with it. So this one passed this third criteria. So at this point, you record the market on your spreadsheet. You will pay attention to the price. The price will change depending on almost every day, multiple times a day. So it's not something you wanted to update on your spreadsheet, but you just want to make sure you have the price on your spreadsheet for future reference. And you want to pay attention to the 52 weeks range. So you wanted to record the lowest 52 weeks price. You wanted to record the 52 weeks highest price on your spreadsheet. So there is an example here, and you wanted to record those on your spreadsheet. You can see the company's name, the symbol the stock is selling on, the price at whatever date, and it is a good idea to even put the date you are doing those research, just if it matters to you, and the dividend. And then when you are on that particular stock page, you record the 52 weeks low and range, and you make sure you have the other sector area field as well. So now that you have those two prices, the reason why I say to pay attention to the prices, at this point you can see how much it is selling compared to the 52 weeks range. And you'll notice that this one is closer to the lowest 52 weeks range. So if this stock is a good one, that is a good time to buy. But we don't know if it's a good one yet, because you have not sifted through all your filters yet. But it's good to acknowledge that it is on the lowest price at the moment. So if you pass all your criteria and you have some money to invest, even if that's just one share you want to buy, you can buy it to have it in your amount, your stocks that you purchase. That way you don't have to go search it again. You have a sample of it in among your stocks that you can just go from there. So the next things you will look for is the dividend. So you want to scroll down, and there are a few things from the dividend section that you wanted to record on your spreadsheet. Keep in mind that the dividend yield, the annual dividend yield, does change as well. Now, on a regular basis, but it does change because it's affected by the price. So now at this point, you wanted to make sure you have the dividend yield. You will acknowledge if it's paying quarterly. Most of them will pay you every quarter, but some of them can be once every 6 months as well. So it's good to see how they are paying. And then the next thing you wanted to pay attention is which month of the quarter it pays. So this one is in September. So September, let's see, we have January, February, March, that's quarter one. April, May, June is quarter two. July, August, September is quarter three. So that means September is the last month of quarter three. So that means this particular stocks pay month 3 of the quarter. Don't know if it makes sense. It's not necessarily about September that we are interested in, but which month of the quarter it pays. So month 3 of the quarter. So it might be a good idea to take note of that on your spreadsheet. At the beginning, it may not matter, but down the road, when you want to be more strategic about the stock you are investing in and you have few stocks to choose from to invest in at a particular time, and you want to invest in just one of them, it might there are two things you can consider if everything else is equal, is which month are they paying dividend. So let's say one of them is going to pay you dividend the next month, and all the others pay dividend already. Maybe the one that is going to pay dividend the next month might be the one you'll select. Another reason why it will matter for you when they are going to pay dividend is if you notice on your spreadsheet where you are tracking dividend you are earning from those companies. If you notice that there is a month of the quarter that you don't make a lot of dividend, then you wanted to see which one of those stocks that you downsize to invest in, and you want just to invest in one, which one is going to pay you in that month of the quarter that you earn the least amount of dividend. So, and let me see, and sometimes I do that, I will try to have a list of stocks that are on the lowest, like they are close to their 52 weeks low price, but then I will have multiple in that list, and then I will say, okay, what are the dividend they are paying, and which month of the quarter they are going to pay that dividend, to see what criteria here is going to affect my judgment, guiding me toward this deciding which one I want to invest in. And let me see, and at this point there but anyway, but yeah, I do that. I do go through them and see which one are on the lowest, and by looking at them, because I have them already on among my stocks, it's easier to see which one is on the lowest, and then I go from there. But we are not going to spend a lot of time on this yet, so let's go back. So now that we know why we are recording those dividend information, you'll go back and analyze the chart, and we do not want the 1 year chart, we want the maximum. Therefore you will click on show more, and when you click on show more, you want it to make sure it's showing you maximum chart. If it's not, you will need to click on it and find it and click on that maximum. But we have the maximum chart. So when you have the maximum chart, you wanted to scroll down and pay attention to the year it went public. It's not necessarily the company started, was created, but it is the year it went public. Or that's as far as Charles Schwab has a public record of financial information on the company. And this one is 87. So you wanted to add that to your spreadsheet. Because that is a criteria of us, and we set a criteria to invest in dividend stocks that went public before 2000. You can say your own year. Maybe 2000 might be too strict for you. You might want something after 2000, or you might want something even before 2000. Personally, I like 1980. Anything before 1990, I like those type of date to work with. It shows me that the company has been around for decades for me to trust it, because you notice that I'm not analyzing too much what the company is about. I'm just looking for other information, and I like to make sure the company is old, and that's the first things you wanted to record. And if we are working with companies before 2000, so if at this point the company was 2002, for instance, therefore it failed this fourth criteria, and you do not continue forward, so that one is out of your list as well. You don't need to remove it from your spreadsheet. You can even add the year, but you just don't move forward with it if you don't have time. So, but this one will continue. So it's 1988, that's good. It passed that filter. But now you'll analyze the shape of the chart. You want the chart to be, I don't know if, oh, sorry, I shouldn't have done that. Okay, so first, let me do this. Okay, so you want the chart to have that oblique shape. So now you look at this, and you can use your own terminology to name the chart that you are looking. That's why we are looking for long-term chart to analyze. So when you are looking at it, what shape it has? Is it upward? Is it growth and dip? Or is it downward? So we are going to look at few samples for you to immerse your brain with those images, and then we'll come back and analyze this chart. Okay. So we have an example of criteria that we set here, and let me make it a little bit. So we have upward. Okay. Upward growth went public before 2000, annual dividend 2% and up. But why we are here is the chart. Did you see the look of this chart? I name it upward growth, and that's Home Depot. And this one is Verizon, and Verizon is growth and dip. And by growth and dip is you are seeing up, you are seeing down, you are seeing up, you are seeing down, and those up and down are quite obvious. They are big jump, big dip. So I like to call it growth and dip chart. You can name yours any way that pleases you. But the point is, what you want to pay attention is when the price is start selling originally and the price is selling now, and if at any point during the past it went low to the price it was selling originally. So you want to avoid that. So by growth and dip, yes, it's showing growth, it's showing dip, but when you look at it, you see growth in it. Growth look in it, growth tendency in it. The price is selling is not currently is not as low as the price it originally started decades prior. So let's go to, so this one, okay, I have it at the bottom. This one is Chloros, and this chart I'm calling it upward. This one is caterpillar, and this one I'm calling it upward as well, because you can see how much it starts selling and how much it's selling now. Yes, we do have those big jump and down in it, but really it has that upward growth to it. So therefore I put it in upward category. So this one is Colgate, and Colgate, you can see it is upward, and I like the Colgate chart because the growth and the dip are very small, so you can see the upward growth to it. And yes, we do have some dip that are obvious, but the zigzag is small. That's the point. When the zigzag is small, I like to, and I can see the growth clearly, I like to say it's upward chart. And this one is a very good one as well. It's Johnson & Johnson. Again, the zigzag that categorizes the up and down is kind of small, and you can clearly see the upward trend of the chart. From 1980 to 2022, you can see that at no point it went down to the price it was selling originally. So it's very upward growth type of company. There is growth to it, so it's upward. And this one is Enbridge. And Enbridge, I put it under upward as well because of the price is start selling originally and the price is selling now is quite a big jump, and so it does have that growth to it. Although you can see the growth and the dip, the big up and down, and you see this, but there is a lot of smaller zigzag, and you can see the obvious growth. And but between 2012 and now, you can see that growth and dip there. So I put it under upward. But again, if you want to put under growth and dip, that would be fine. But for me, it is upward because it is really oblique. If I pick this end point and I pick the start point and I try to join both, it will be oblique line. That's the point. The end point, the price is selling now and the price it was selling originally. When you pick those 2 points and you want to join them with an arrow, what shape will be the arrow? Is it upward look? If so, that's upward. So and this one is General Mills, and it has upward look as well. We pick the start price, we pick the, let me charge my computer. We pick the end point, and you have that upward growth to it as well. So yeah, that's a good shape here as well. And you can see the zigzag. The zigzag is very small, so that is the zigzag. By a zigzag, that's the growth and the dip. So I like to call it zigzag. Let's use simple word that will help us understand what we are talking about. But when we join when they went public price and what they are selling now, those 2 points, when we want to join them with a line, that line will be oblique. So that's upward. That will have from down up. So the arrow will be facing up. So that's upward. So let's go down and see if we have. And another one is, Home Depot. We talk about that one. So an example of growth and dip chart. And this one is Verizon. And you can see Verizon has growth to it. If you wanted to bold the price is selling in 1984. Is it 1984? And then the price is selling now. And you want to join them, you'll have that growth to it. However, you can see a big up and down in it, quite a bit. Therefore, I like to say growth and dip. But I wanted to make sure there is still growth to it. The price is selling when it went public, and the price is selling now. You want to see that oblique line in it. But because of the big dip and up and down, it is growth and dip. And this one is Pfizer. And Pfizer, the price is selling originally in the 80s, and now you have growth, but it does show you those big up and those big down, deep. Therefore, I put it under growth and dip. And that is just my way of describing those charts. And this one is Ford. And Ford is one of the stocks that I will advise against, because again, it is growth and dip because of those big up and big down. However, when you look at those dip, at some point it went down to be close to the price it was selling when it went public. So that's very dangerous. You do not want to invest in those stocks for long term if they are going to, at some point, there is a possibility that they can go down to the point to reach the price they went public decades prior. So, although I have some Ford, that's something that I will not advise. I'm not talking about Ford necessarily, but any stocks that when you are analyzing the long-term chart, that will show you those growth and dip. And the dip, you want to pay attention to the dip. If the dip is low to the point that it can be close to the price it went public the case prior, it is a risk, because that means during recessions, or whatever year that dip happened, which was in 2008, that was a recession. During those recession, there is a chance that that company stocks will go down. And if you want to sell stocks, it won't be, you should not sell it around that time. I don't know if it makes sense. So Ford pay high dividend, but that's something to keep in mind if you choose to invest in a stock like that. Yes, when there is a recession, you do not want to sell it if the price went down to be below the price you originally purchased it. I don't know if it makes sense. Okay, so now that we immerse ourselves with those type of shapes, let's go back to our thing. So when you look at this chart, what do you see? So first, pay attention to the price it was selling 1987 and the price is selling now. So if you only just pick those two and you want to join the by an arrow, what shape the arrow will be? It will be down. It will be from up down. So because the price it was selling in 1987 is around $8.86. When I put the mouse here, you can see the price, and the price is selling now $6.97. And even at some point it went below that. So for me, this chart is growth and dip. You might call it like that, but I will say it's downward. And again, downward chart is a no-no. And this, it met our criteria up to this point. Downward chart is no-no. This company is not good to invest in long term. So therefore, you will put downward for that company on your, we have an example here. You put downward, and it's pretty much that means you should not invest in the company. So, but again, if you chose to invest, or if you invested, because sometimes, depending on when you did your search, you might think it's growth and dip and invest in it. But then later, when you analyze it again, you might say, you know what, this is downward. Therefore, you put a mark on your spreadsheet not to invest more into that stock. So now that we are done with Cato, let's look at the next one on our list that we want to analyze. So we are going to go back up. The next one is FL, and that's Foot Locker. So FL, you'll tap, and I think it's going to have us on the chart. So we are going to close the chart, and we will put FL, and we'll click on Foot Locker. And even here, I like to backtrack as well by working on the first page, changing the data and working on the first page, and then later go to the chart. But we can just go through the whole process with each one of them for you. So the third criteria we want to look at is New York Exchange. So it passed that criteria, good. So while you are here, you want to record the 52 weeks low and the 52 weeks high. So 1484 and 4722. And while you are here, why not comparing how much is selling now to the 52 weeks range? At this point, that mark there is the price on that range. So at this point, it is closer to 52 weeks low than it is to 52 weeks high. Let's continue to the dividend. And you will go to the dividend, and under dividend, 8.16%, and is paying the first quarter or the first month of the quarter. The first month of the quarter. Okay, so now you'll record those to your spreadsheet, and then you'll go to the chart and you'll click on show more. And under show more, you want to make sure you have the maximum chart. And you want to scroll down to see the year. And for this one, we have 1980. You want to add that to your spreadsheet. 1980, it met our before 2000 requirement. That's good. Now let's look at the chart. So it is selling. That's the point it was selling. And that is the point is selling now. So there is some growth to it, but when you look at it, it is automatically growth and dip, because you have big growth, you have big dip, growth, dip, growth, dip, growth, dip, and they are obvious. So growth and dip. So you wanted to see that growth and dip chart, if it's showing growth or just downward type or too much. So pretty much you wanted to see if the dip at any point went as close as what it was selling originally. And the answer is yes. Those dip are quite down. So, and not so much in the future, but they are quite down in the past to the price it was selling, and therefore it is growth and dip. It is not downward, because you can see the price is selling now, and the price it was selling in 1980 and the price is selling now. And if you want to actually see the dollar amount, when I put it here is 538. You can see the price on the right side, and now is 19. Let me move it up. 19cc. So there is growth to it, but it is growth and dip chart. I will call this growth and dip chart. So for growth and dip chart, you want to set your dividend yield high, because during recessions, if you look at the year the dip happened, 2008, 2020, it is during recession. So that means during recessions, that stock will go down. The price will go down. So because of the growth and dip and those big dip, you want to set a high dividend yield for those companies. So again, criteria. So we have, let me see what I have for criteria wise here. So for growth and dip, I said 6% and more. They have to be paying 6% and more for me, and be around before 1999 for me to invest in them. So I set a higher dividend yield. While for upward, I was okay to scheme the best, and in fact should be work from it down to 3% for upward one, because a lot of upward companies, very few will pay 6% and up for upward, but you want to invest in those, invest in 5% and up, invest in 4% and off, and invest in 3% and off, pretty much. And then use the growth and dip chart and to narrow down the high paying dividend yield, dividend stocks that have been around before 1999, and to invest in those as well. But your criteria could be more strict or more flexible than mine. I'm just showing you how to set those criteria, how to find those dividend stocks, so and how I analyze them. I don't get to know the companies. It takes a while for me to actually know about the company. I will get to that point asking myself what that company is about anyway, if I keep adding more and more of my money in the companies. But until then, that's just the surface research that I like to do about them. So now that we are done with, and so by looking at this one, let's go back to, for this one, it is growth and dip, and it is paying 8%, and it has been around since the 80s, 87 I think, is growth and dip. It has growth in it, therefore you can invest in it. I could invest in it. It passed our criteria here. It's just that you won't be able to sell it during recession if the price you pay for it is higher than the price is selling at that point. But until then, it's going to be generating dividend for you. Has been around since the 80s. It's paying 8% dividend yield at the moment, and it has growth in the chart. So it is a win, this one. So let's go back and see which one is the next one. The GES INC, GES. GES, GES. Let's click on that. So GES the third criteria, the stock market, it passed that, good. So you'll go ahead and record the 52 weeks low range. That means the lowest is sold during the 52 weeks, 16.14, and the highest is sold 24.84. While you are here, you may want to compare how much is selling now. Oh, first, before we continue this one, let's do this one again. So we say it's a good one to buy. So let's see if it's a good one to buy now. It is, because the price is selling now is close to the 52 weeks low than it is to 52 weeks high. So if you are going to invest in a long term, yeah, it is the right time to buy one share if you want, or buy more if you want to. But yeah. And while you are setting the price though to buy it, if you have a feeling like it could go down more, you can set a lower price. But if you want to catch it before it starts going back up, and you are not buying a lot of share, you can set a price a little bit lower than the price is selling now. But we are not going to talk about how to set the price when you are buying stocks, but we are just going to say it's the right time to buy because it's closer to 52 weeks low. I like to buy stocks when the price is closer to the lowest price for the year, and that's the start. Okay, GS. So now for this one, it passed the third criteria, which is the stock is selling, the market is selling on, and 21.11 is the price, and it's close to the highest price for the year than it is to the lowest price. Therefore, if that's a good company, you put a note on it on your spreadsheet, but it is now the time to buy because it's further away from the lowest price at the moment. So let's go check the dividend. The dividend is 5.68, okay, and is month 3 of the quarter, okay. You put those on your spreadsheet if you don't have those information, and you click on show more to see the chart at the maximum level, and you make sure you have max, and you scroll down to see when it went public. We have 1998, but the chart started before that. So I'm seeing 1996. It's before 2000. That's good. So it passed that criteria of 2000, which is the 4th criteria, if I'm counting well. But now let's see the chart trend, which is the 5th criteria. So first, you wanted to see the price it was selling originally, just ball guess it. And the price is just by looking at where the price is. In case you don't know, the price is at the right and you have the year at the bottom. So that's the price originally and that's the price now. So there is a growth to it. So now when you look at the chart, it has big growth, it has big dip. And when you look at when those dip happen is during recessions, 2008 and 2020. So you have those big dip and you have those growth as well. So it's growth and dip chart with some growth in it. So now you wanted to see if any of those dip are as low as when it went public originally price. So when I put the mouse, when I'm moving the mouse, I'm looking for that black point to be at the bottom of the dip. Is 10 cc, and when I do that, you can see the horizontal line. By horizontal line, I'm talking about this gray line. So that 2008 price is a little bit above it. It's not as low as when it went public. It was 797 here, and during the recession it was that. But in 2020 it went to 528, so it went even lower than the original price when it went public. But it didn't do that in 2008. So 2020, we all know that it is exceptional year. What happened there does not happen during recession. It's a pandemic year, and I think the other pandemic that happened was during the Spanish flu. If I'm not very good with history, so you can see that those pandemic things, thank God, it does not happen often. But just know that during recession, there is a chance that these companies price could go down close to the price it was selling originally. So if you purchase it at a point that it is high, and when during recession, if the price went lower than the price you bought it, you won't sell it during that time. So keeping that in mind, you can even put a note on your spreadsheet. This chart has growth and dip chart. It has been around since 1996, and the dip can go close to the original price it went public. You can put that note on your spreadsheet so that when you are investing in growth and dip chart, when you get to this, you can invest in companies that don't have that issue, those big dip before you invest in this one, or you just invest few of your money in it. But if you ask me though, I will say no. This company is a no buy. For that reason that at this point where the price is, I have seen a lower price before that, so there is a chance that it could go down again, lower to the price it's selling now. And yes, it won't reach the price it originally started, but it could go lower the price you'll have paid for it at the moment. And I think that's the one that it was even closer to. It was not even the right time to buy, because we are seeing 1614 and it's close to the high point. And let's look for that 1614 on the chart here. 1614 is somewhere here, but anyway, so yeah, somewhere I'm looking for it in the, let me go down a little bit. Yeah, somewhere there. But I just feel like it is a no. It is a no. And again, it didn't even pass our criteria. We say if we will buy a growth and dip companies, it has to be 6% and more. And this one is 5 point something. So it's already failed that criteria anyway. $5.60. It already failed. It's not 6. For that risk, I will look for 9% dividend before I made that leap and buy that stock. So 5.68 is even below that 6% criteria that we set for growth and dip chart, 6% and up. So it passed the 1999 criteria, but it didn't pass the dividend yield criteria. Therefore, it is a no. Okay, so and that's how you filter down the stocks you originally add to your spreadsheet. So far we have FL, that is a yes. And now let's do gap, GPS. Gap passed the third criteria, New York Exchange. You pay attention to the 52 weeks low and the 52 weeks high, $7 and $15. And you, while you are there recording that on your spreadsheet, see how much it's selling. It's selling for $12.86 and it's close to $15 than it is to $7. Therefore, if that's a good company, it is not the right time to buy. So let's go to the dividend. 4.3% in first month of quarter. Okay, let's go to the chart. The chart at maximum level we will look for the year it starts. 1980, good, it passed that fourth criteria. At that price, if I click on the price now, there is growth to it. Good, there is a growth in the chart. But now how the chart looks like, it is growth and dip. We have big growth, we have big dip. Good. So now the dip, does it get close to the 52, the original 1980 price? The answer is no. Therefore, it's a growth and dip chart. Good. So the rate is 4%. Therefore, it didn't pass our 6% criteria. You'll add all those information on your spreadsheet. You just don't invest in it yet because it didn't pass your 6%. The only thing she felt is the dividend yield is low for those big growth and dip. So, but the good news is the deepest it got over the years, you are not too far from it yet. But you don't want to spend your money buying those low dividend stocks that show growth and dip chart if there is a chance you'll find better. That makes sense. So it is okay to buy some at some point, but not right away. And even so, it is close to the highs at this point. Therefore, it's not even the right time to invest in it. But by looking at this chart, if you compare it to guess that we previously work on, this one is better chart than the guess chart. Therefore, this one you can invest in it, but the dividend yield is 4% if it does not bother you. But it has been around for a while. It has growth in it, but they are so big growth though, and way more growth than dip. Like you see the dip is not deep like how tall the growths are. So that's a good thing. You just don't want to be buying it at the ceiling of those growth though. But yeah, you want to buy it at the close to the floor of those dip. But yeah, it is a good one to have on. It passes your criteria, fail the dividend yield criteria, and that's just that. But rather than that, it is a good one to invest in after you invest in the high-paying dividend growth and dip chart stocks. I don't know if that makes sense. So you can put a note on it on your spreadsheet that it is a good one to invest in after you invest in the other good growth and dip companies. So again, it has big growth, but the dip are not too deep. And the deepest one didn't reach the original price. Therefore, it's okay. It just does not pay high dividend for you to be riding the, to go for that ride, up and down ride. Okay, so now let's go back again. So GPS is good, but has low dividend yield. Is good growth and dip chart stocks, but has low dividend yield. That's that. So it didn't pass our dividend yield 6% criteria. But I don't think that's a reason to eliminate it completely. But I will eliminate guess. I will eliminate keto. And in this list so far, FL and GPS are good. If you are going to choose between the two, we should have done that right. So I believe both are growth and dip. We have to check this chart though. That would be a good thing to compare both charts to see which chart is better. This one has a higher dividend yield. which compensates for those growth and dip. This one has a low dividend yield, but the dip is not too low. So let's do the baby one, baby store INC BB. So BB, the third criteria didn't pass, is OTC, over the counter. So at this point, you don't even go forward. It didn't pass your market that you want to buy. We don't want to include over the counter companies because they are riskier. So I'm not even going to go forward with it. So it is to eliminate. We will go to BKE, Bucklo INC. BKE. So Bucklo INC passed the third criteria, is selling on New York Stock Exchange. You record the 52 weeks lowest price and 52 weeks highest price. So 30, 18 to 50, 35. And while you are there, you can pay attention to the price is selling now to the price to the 52 weeks range. So it's close to the lowest price of the 52 weeks range. So if it's a good company, after passing all our criteria, it is the right time to buy. So let's go to the dividend and take a look at it. It's paying 4%, 4.23%. So it better be upward. Chart. So and first month of the quarter. Okay, so let's look at the chart. We at the maximum chart. We wanted to see how far we have information on it. 1994 is before 2000. Okay, so it passed that criteria. So it started around 1992. So you can record that on your spreadsheet. And the price it was selling originally, you can see the point, and the price is selling now. You can see the point. So there is growth in it. So now let's look at the chart. So because it has not been around for long, we will see more the zigzag. But at this point, I will say it's growth and dip. It has a big growth. It has a big dip here. So let's see how deep. So at this point, we will say because we have growth in the chart from the beginning to the end, when you trace to join those two lines, it will be oblique upward shape. So it has growth to it. But the shape of the chart is growth and dip because those zigzags are quite pronounced. So we will say that's growth and dip chart. But now let's pay attention to the dip, to the floor of those dip, or to the deepest it went in the past, to see if it got close to the original price. And the answer is no, it didn't get close to the original price. So it is good. It goes down, but it does not go down too much. But you just know that during recession it will go down. That's 2008, and that's 2000. I don't know what happened in 2017, and then 2020 it does go down. So, and 2022 it has been there too. So yeah, so just keep that in mind. Those growth and dip chart, during recession the price will go down, and if it goes lower than the price you pay for it, you won't sell it at that point. But by looking at this growth, we'll be able to say that it does have growth in it. Even though it has growth and dip, it does have growth to it. So if you are investing for long term, it is a good one to keep included in your list. They only, if the last criteria though, the interest rate, the dividend, the annual dividend is 4.23%. So it is low, it's below 6%. So it is good to have few after you invest in the high paying dividend that are growth and dip chart. But by looking at this chart, I will say it passes all the criteria, but the dividend yield rates, the dividend rates criteria, and I don't think that's a criteria to discredit it or to discontinue or to remove it from the list. Now it is just a criteria that makes it that you do not prioritize it over the high paying dividend growth and dip stocks that will pay you 6% and more. So now I think we exhausted our list. Now let's compare the one we kept. We kept the Foot Locker, the GPS Gap INC, and the Big KE. So let's see, let's compare them. I'm going to take this one out of here. I'm going to take guess out, and I have those three. So let me see if it's going to allow me to, okay. So let's take a look at this, the way it look, and let's go to the gap. And when you look at the gap and you look at that one, so the gap is even older, 1980. The other one is 1997 or so. But the gap can goes down, and I will say that the gap has a better dip than the buckle, and it has been around even longer, and the dividend yield is better than the buckle. So if we come back to the buckle one, I have to say the growth is quite pronounced here though. So you can see that having both is good for your stocks if you don't mind the 4% they are paying, or after you invest in all the 6%. And this is the gap. So you can see that the gap is a little bit on the low side toward the end here, which is a good thing in a sense that you are not buying, at a peak. If it goes down, do you see those big up, and then you have those things here? So buying it around this lower, when is at the lower, is a good thing, knowing that there is a chance you'll have those big ups before it goes to another of those big up again. And I don't know if it makes sense what I'm talking about, but it's just those things that is not set on stone. And those charts will change over time. So sometimes you'll analyze in a certain way and you'll buy, and then later you look at the chart again and you say, I've been too soft on this stock. I shouldn't have bought it. Therefore, I don't want to invest more in it. And it is okay. So, and when I look at this one again, the buckle, where it is on the lower side compared to those peak. but not compared to this dip here. So that's something to consider. And overall, both are okay to have in your stock, in your portfolio, in my opinion. But if you are wondering, should I buy now? If you are going to buy now, like buy one share to have in your portfolio, so that you don't have to go back to your spreadsheet looking for which one to invest again in. One share, buying one share. The buckle is at the best, is around the best, is the best time to invest in it, because it's close to the 52 weeks low range. The gap, on the other hand, is close to the 52 weeks high range. Therefore, it is not the right time to buy the gap. It's better you take a note of it on your spreadsheet, where you have the list of your companies. And sometimes I like to put asterisks or notes, so that quickly when I come back to the list, I can quickly notice the one that I put note next to, and put highlights or change color for the one you already purchased. Is a good idea, so that you know that you already purchase those. Another things I like to do as well is refilter all of them, so that I can have growth and dip together by themselves, and upward together by themselves as well. That way I can filter. You turn it into the table, and you can just filter by dividend yield and go from there, by investing in the high paying dividend first and go all the way, So you just, once you go to all the stock markets, all the sectors, all the industries, all the sub-industries, to filter, applying your filter and put those stocks on your spreadsheet, you'll have your master list that you can now divide into smaller lists based on whatever criteria you aim for. So now let's compare those to the full locker. The full locker, if you want to buy, is close to the 52 weeks low, so that'll be a good time to buy as well. But let's look at the chart again. It's just this one that I'm not okay with, the dip, because the dip can be very low, close to the original price. So, and the good things about it is on the low side, is on the dip side now, compared to those huge peaks. Is on the deep side now. So if you want to invest, having a wallet on the deep side, because it is good things, is not too far from those deepest one that it has been before. So, but again, it's further down compared to those huge peak. So, and if I want to compare the Food Locker to Gap and Boko, GPS and Boko, I will say the GPS is the first, the Boko is the second, and the Foot Locker is the third, in terms of how good their charts are. However, in terms of dividend yield they are paying you, I will take the risk and invest in the Food Locker, knowing that the goal of finding the dividend stock is to generate a stream of income through dividend. So, and the goal is not to sell the stocks to have access to our capital or the money, but while we have the stocks we have our money invested in the stock, we are generating income through dividend. So this concludes the apparel retail. For us, we have FL, GPS, and Boko, 3 that are good, and all 3 are growth and deep. and Foot Locker is the one that met the dividend criteria at the end. The other two didn't. So we explain the spreadsheets and we have our criteria. So at this point, just going to work from this session here. So we use the criteria that we use to find the dividend stocks and narrow them down to the good ones that we can invest in. We first sort them by dividend yield. We make sure they are corporations, and we avoid we didn't have to deal with the international one. The international one will have SA at the end of the entity name. And while we are researching the dividend stock, we eliminate the OTC one, and we only retain the New York Exchange or NASDAQ. And the one we kept, they are all New York Exchange. Baby was OTC, and we didn't even go past that criteria. Once you are going through your criteria, you are sifting them through your criteria. When you fail a criteria, you don't go to the next one. You just eliminate it. So, and new companies, that's when you set the year that you don't want to go past that year. So we said 2000. Anything after 2000 is too young. So avoid new companies and analyze the chart. So the chart trend, is it growth and dip? And if it's a growth and dip, is it the dip close to the first year they went public price? So, and if it's growth and dip, you wanted to see if it's meeting your dividend yield that you set in terms of prioritizing which one to invest in first. So, and then when can you buy? If the price is selling now, it's close to the 52 weeks low, and that's when, if it met all your criteria, you can buy. So now let's talk a little bit about the brokerage account. So when you are investing with the goal of generating dividend stock, with the goal of generating income through dividend, I prefer brokerage account over Roth IRA and IRA. You can have all three with Charles Schwab or brokerage firms. And because I invest in individual stocks with Charles Schwab, that's why I like to use Charles Schwab to make the video. But it does not mean that's the only one out there. But I like it because it has been around for decades, so I trust it. And I think trust is a big word, but it makes me feel confident that I'm working with a solid company. I think that's a better way of putting it. So I'm a little bit suspicious of the new brokerage firm, not because they are not good, it's just because I'm investing for long term, and I just don't want to focus on the deal I can get now by investing with them, by setting up an account with them, over the amount of money I'm going to be investing there for a long term. So I want to make sure my money is put in a safe place. So for that reason, I like to work with Charles Schwab. That's a good brokerage firm where you can purchase individual stocks on your own by yourself. And you can do that online. So, and brokerage firm allows you to access your money anytime you want to access it. If you want to trade the stocks, you want to sell the stocks, you want to withdraw the dividend paid, you can do that without the government telling you when you should take money out of the account. The one thing you need to know about the brokerage account is any dividend you earn, you will pay tax on it, whether you reinvest it or take it out or took it out. you are going to pay tax on that. So it's taxable. The money you are investing is after tax money because it's your paycheck, your money that you took home, that you take out of to invest. So it's after tax income of yours, and the dividend you are making on that money through dividend stocks, you are going to pay tax on it. But you can touch that money anytime. The government doesn't tell you when you should take money out. The Roth IRA is a retirement account that you invest after tax money in, and when you retire, the profits that your money generates, like the growth you got from investing in stock in your Roth, when you take the money out, you do not pay tax on it. You don't pay tax on that, on that growth. And you don't pay tax on your capital either. However, the government has a rule on when you'll take money out. So if you want to take money out even earlier than your retirement age set by the government for that account, you have to invest in that account for 5 years. You have to have the account for 5 years at least, or for more than 5 years, and you can take your after tax money that you put in your capital, your principal, out without paying penalty on it. You leave the growth, how much your money generates in the account, but you can take your capital out. But again, when you file your 1040, you have to file extra form to specify that the money you took out is your principal, to track it. So again, it is now an account for you to feel financially independent on. So, but it is a retirement account. And the IRA account is an account that you put before tax money in a way that you put after tax money in, but you can file additional tax form during your 1040 and to make it before tax money. And then when you retire, set by the government for that account, and when you take money out of it, everything will be taxable. So those have rules, and they are more designed for retirement, and then they are designed in a way that you'll take money out until it's zero out. So pretty much you sell stocks to access the money. You sell stocks periodically to access the money. The brokerage account, what I like about it, even though it's taxable, every penny you generate profit-wise, income-wise, is taxable. I like it because it gives you that freedom that the government doesn't have a say on when you can touch your money, how much you can get out of it a year or anything like that. You just know that dividend you earn, you'll get 1099 from Charles Schwab or your brokerage firm, and you will use that to report your dividend earned on your 1040. It goes into your income, your total income earned during the year. That's one. Second, if you sell stocks and you make profit on it, it goes on your 1040. It shows up as income as well. And if you sell stocks and you lose money on it, it will go on your 1040 as well, and will show a loss there as well. So transactions happen on the brokerage account, you will report those on your 1040 to pay tax or to show a loss. So but if you are the goal of our content information we share is to reach your financial independence. We are we use different ways to save money, different ways to make money to reach our financial independence, and things that we are learning, things that we think we can all learn from. I like to share that as a content for all of us to access the information. And if you are trying to become financially independent, you don't want to wait until you retire to access that money. You want to have multiple sources of income so that you do not depend on your employer to put food on your table, to feed your children, you want to have multiple sources of income, the brokerage account is a good account, in my opinion, for us to build that wealth in by investing in dividend stocks where we can earn income through dividend, with the goal that those income through dividend can cover our basic living expenses without too much want in it. I don't know if it makes sense. So how much to invest in dividend stocks? I mean, there is different way to approach this. You can set a minimum annual dividend income. I like to set a goal. So you can set a goal like the way I say, if you are trying to reach your financial independence, there are different ways to go about it. Some like to have $1 million worth of asset and say they are financially independent. And the way I view it, for us to be financially independent, is to have multiple sources of income, have income streams that continue and is not tied to our time, and generate enough income to cover our living expense. So that means first you need to be frugal, keep your living expense low so that you don't have a high dollar amount to set as goal. That way you can reach that goal faster. So if we say that our living expenses is, let's see if we can find an example here. Let's say if we have a living expenses, a basic living expenses for 1,000, and by I'm saying 1,000 because there is allowances for $200, and in case of temporary job loss, that allowances can come off, and if allowances come off, it will be around, let's say 900 or 800 something. So if we just say 1,000, just to round numbers, for basic living expenses, and for irregular expenses, that's where some of our wants are included. But if we revise it to just keep the basic, including car insurance, home insurance, and home repair or home maintenance, those are annual budget divided by 12 will gives you how much you should put aside in a saving account a month to cover those irregular expenses. I like to call it irregular expenses, not emergencies, irregular expenses, because they are expenses that could hit your account during the year, not on a monthly basis, but some point during the year. And you want to see how much a year you can spend on each one of those categories, and total them and divide it by 12 to find the average to save every month. So if we say it's about 1,000 as well, just by rounding, we say about 1,000 as well, then you have 2,000 a month to work with. So if we go back to where we were before, so if we say 1,000, we want to generate, here we are just starting low. You set an average. You say, okay, so I want to earn 1,000 dividend a year. In the example I was talking about, when I was talking about if you go with your living expenses, which means you have to have a budget to know how much you actually spend a year. So that way you can go from there. You know how much you need a month, you time it by 12 to see how much you need a year, and you go from there. But let's work with 1,000 a year in dividend. If you want to make 1,000 in dividend a year, how will you reach that goal? So you will first set the dividend yield that you want to earn from those stocks, from those companies. You saw we came across Foot Locker that is paying 8%, and we saw GPS that was paying 4%. So if we set 6% as an average, and that's what you want to target, 6%. So you'll take that 1,000 that you want to make a year and you divide it by 6%. So that means you want to have invested 16,000, let's just say 16,700 a year to generate 1,000 a year in dividend. And if you work with 5%, so you'll need to invest $20,000 to generate $1,000 a year in dividend. So when you see it like that, then you'll say to yourself, okay, I don't have $20,000 to invest right away, and I don't know for sure I'll be able to invest $20,000 in 1 year for me for the next year to generate $1,000 in dividend. So you want to make a routine out of it, and we are all different. I like to turn things into routine so that I can just do that, and it become a habit for me. So that's just my way of doing it, but it may not be your way. Just keep that in mind. A lot of time our personality flows into advices that we give out. So just trying to be able to take the advice out of the personality and see which part of the advice can fit your personality. So 20,000, say, okay, so maybe I cannot save $20,000 in 1 year, but what if I say 10 years to reach that goal? That by year 10, the account should be able to generate $1,000 in dividend a year. So you take that 20,000 divided by 10, it gives you 2,000. So that means every year you need to invest 2,000. So how much a month do you need to invest then? So you take that 2,000, you divide it by 12, it will give you 166.67. So that means every month you need to invest $167 in your brokerage account. And then when you have time, you go there, go through your stock, and then find the right stock to invest, and then go to your Charles Schwab account and invest. And do that, and before that year 10, you'll reach that goal, because those income will get reinvested. And yeah, those income will get reinvested, and you don't even have to invest $20,000 before you start earning $1,000 a year in dividend. So, and that's just an example there. So another option would be to say, yeah, and that's pretty much what we cover. And you can also use your living expense, like the way I say before, to set a goal and going from there. So if we say we 1,000 for basic living expenses, another 1,000 for irregular expenses a month, that's 2,000. So you can target the first 1,000 for your living expenses, and that's 12,000 a year. If you take that 1,000 times 12, that's 12,000 a year. And so at 6%, you will need $200,000 invested to generate $12,000 a year in dividend income. And then you take that 200,000, you divide it by 10 to see how much you need to invest a year, and that will be 20,000. And you divide that 20,000 by 12 to find how much you need to invest a month. And that's 1,667 you need to invest a month, and invest that in 6% or so dividend stocks to generate, and do that for 10 years to generate 20,000 dividend income a year. To generate what? To generate $12,000 a year. To generate $12,000 a year. So the things work like this. If you need $1,000 for your basic living expenses, times 12 will give you $12,000. Divided by 0.06, if you have 6% stocks to invest in, that's $200,000 you need to invest to make $12,000 annual dividend income. So $200,000 is a lot of money. So if you say you are going to reach that goal in 10 years, that's $20,000 you need to invest a year. If you divide it by 12, that is $1,667 you need to invest a month for 10 years to generate $12,000 a year in dividend income at 6%. That's why the dividend rates that you work with matters. If we did the same thing with 3% dividend stocks, you see that you need twice as much to work with. From 6% to 3%, you need twice as much to invest, from $200 to $400 to generate $12,000 dividend income a year. That's why you need to know the minimum you are willing to accept from those companies dividend yield wise. And for companies that have upward growth, the minimum you are willing to accept as dividend yield, and for the one that show the growth and dip, the minimum you are willing to accept from them. Set those rates because of the goal you are trying to reach, the type of income you are trying to generate from that type of investment. So, and we discuss having your own budget to be able to know how to go about it. Another way to go about it as well is choose a specific expense category and say, you know what, I'm going to invest in the stock market in dividend stocks for the dividend to cover that expense for me. You can turn it into a game and say that, let's say I'm paying, don't know what kind of example I use in here, but we can use it. So if you are paying $50 a month on for your cell phone, and that's $600 a year you'll be spending on phone. So you can decide that, well, a company needs to be paying you for that. It needs to be paying for that expense. So you'll take that $600 divided by 6% interest dividend rate, and that'll give you $10,000. So that means if you invest $10,000 in stocks that pay 6% annual dividend rate, you'll be making $600 a year in dividend. That could cover that expense. So that $10,000, if you divide it by 10, it'll give you $1,000 a year. And if you divide it by 12, it'll give you $83 you need to invest a month to reach that goal in 10 years. And when you reach that goal, you can tackle another category expense again, and before you know it, you'll cover all those expense categories that you have. If that's just some fun expense category that you want your dividend income to cover, why not? Like traveling, for instance, you can just pick those as well. So the choice is yours, but those are just some food for thought. Okay, so now, how many dividend stock do you have in your portfolio? Again, I will say it's not so much about the number of dividend stocks to have. Is you might want to just tackle all the let me see if I have it here. the sectors. There is a lot of sectors, so and the way I show you how to find the dividend stock, you will go through all those sectors, and you have consumer stable, consumer discretionary, consumer communication service, financial. You go through all of them to find the industries, the sub-industries. This is the sector, this is the industry, this is the sub-industry. So by the time you go through all the sectors and go through all the industries and the sub-industry to find the companies and filter the high-paying stocks, 3% and up, you'll have a master list of dividend stocks that you can, with your note, as you individually look through those companies and search those companies to look at their chart, to describe the chart, and you take a note of the one that are good for you, and you invest in them as their price are close to their 52 weeks lowest price. By the time you invest in all those companies you highlight in your spreadsheet that you want to invest in, you'll have a good number in your portfolio. So just by reference, I put 100 different stocks here. That's a good average, and then you'll just keep reinvesting in them. So the way I like to do that is, I'm not going to go back to let's see if I'm not sure we have an example here, but when you go to your account, under account, when you click on summary, it will take you to your main page, and you will select the account that you are trying to create that dividend income in, and you can just find the list of your stocks there. And when you see the list of your stocks that you already invested in, that you already invested in, it will show you the company, the stocks, and based on the criteria, it will show you their low and their high. And let me see if I can find so when you go under your account summary and you click on your account to see the position, you'll be able to see the stocks you invest in, and you'll be able to see the one down the low. So pretty much the way it looks is the cost basis is the amount you pay for, the price is what is selling, and the quantity is the number of shares you have. So the market value is based on the price is selling now and the number of shares you have. When you time price by the quantity, it will give you the market share. So that means if you want to sell at the market price, that's how much you will make out of it. And based on how much you pay for it, you'll have a loss. So those are unrealized loss. Because you didn't sell it, they are lost, but you didn't realize those losses. So when you look at the one that in the red, it's telling you that they are on the low side. Therefore, you could click on them to see what the price is compared to their 52 weeks low, and then go from there. And your account has a setting that you could click on to show the different tab you wanted to display on your page. And having the different yield, the dividend yield allows you to quickly know which one is paying you high dividend as well. And if you come across one that is on the low, the price is on the low side, you will see if it's paying you high dividend for you to bother trying to invest more on it. And again, you want to pay attention to your spreadsheet to make sure the note you have on your spreadsheet is guiding you. And either one of those companies, when you click on it, you wanted to make sure you like it, because it's not because it is on the low side that you should invest more. You might like it when you invest it, and you may not like it later based on how it's behaving. So this one, for instance, we can just click on big lot, for instance, and search it. And it is selling for $4.30, and the lowest price is $3.73. It's close to low than it is to the highest price, which is $20, within the 52 weeks range. And you go to the dividend, is 27.91% dividend, but it's not paying dividend at the moment. I don't know, maybe. And sometimes when they are in trouble, they stop paying dividend. That's something to consider. That's why it's good to be diversified, because when there is a crisis with some of those dividend company will pause their dividend payment. So having a diversified portfolio allow you to not feel the impact income wise. So when we go back and we look at this, that is the price it went public, and that is the price it's selling now. The price it went public is a little bit below the price it's selling now, but this price is still low. So it has some growth to it, but this dip is getting lower and lower, and is getting close to the price it went public. So at this point, I will not invest more in it. I don't know if it makes sense. So that's that. So you will encounter some like that you might like based on how you judge the chart, but then later when you look at it, you'll say, no, I'm not going to add more money to this one. Another one in the portfolio is MO, and MO is on 3M. And 3M the price is selling 87, is close to 85, 52 weeks low, than it is to 133, 52 weeks high. And when you look at the chart, it has growth to it. Some might say growth and dip, and it is fine, but I will say growth. The price is selling, is sold originally, and the price is selling now. It is upward, is growth. And in 2008 perhaps, it went down, but it didn't reach that lowest price. Even now it's down, but it's not reaching that lowest price. So at no point it went close to that lowest price. And because there is not a lot of growth and like a lot of big up and a lot of big down, I will say upward trend. But these past few decades, we have quite a bit of growth and quite a bit of dip. So if you say growth and dip, that's fine, but I will say growth, I will say upward. And for this one, if we look at, it is on the low side. So, and in the account, it is on the account, the price we pay for it was higher than now. So it is in the red in the account loss wise, and the dividend yield is 6.86. So I will invest more in it, and it is the time to invest more because it's close to 52 weeks low. It does not mean it won't go down more, though. It can continue to go down. But if you have money, you want to buy some now, yeah, it's the right time to buy, because the price is selling now is close to 52 weeks low. So yeah, so it is continually you'll check those stocks to and let me see here. So when you go to your account, even if you just bought one share, when you go to your account, you already have it in your account. You can just see what is in the red, and you check out the price, and you compare the price to 52 weeks low, 52 weeks high, and say, is it the right time for me to buy more? And then you check the chart and look at the chart to see, is the chart still a good chart in my opinion for me to add more money to this stock? You see, so you will constantly be making those choices. So if it's on the low side, comparing the price to 52 weeks low and 52 weeks high, and yes, yeah, you can buy, but then you look at the chart to see, yes, do I still like this chart? And look at the dividend and see how much is paying as the dividend. Are you still okay based on the chart trend? Dividend is paying you. Are you still okay with it? If so, then you buy some more share of that. So having a list of those companies in your portfolio, you can just look at your portfolio, scroll down to see what is in the red, and see if you still like it based on those two things that we evaluate: the price compared to 52 weeks low and high, the dividend is paying, and the chart trend. So those three things, and buy some more, or say no, I'm not going to buy more. And if you don't like the company, then you don't want to reinvest the dividend, then you say no, and then the cash will be put in the account for you to reinvest in something else, to invest in something else. But there are some companies that pay dividend, but they do not allow reinvestment, like this one that is a Canadian company. So automatically that cash will be put in your account. So yeah, that is those things to, yeah, once you have a certain number in your portfolio, you can just keep investing in them. And one way to do that as well is to look at the what they are paying the month you are making dividends. And once you make dividend in a quarter, constantly in a quarter, every month of a quarter, that means you reach that goal that you are making dividend income every month passively. So now you look at the quarter and see which month you made the least amount, and then see what companies pay you during that month, that first month of the quarter, for instance. And then say, okay, you will check those companies to see if they and I think 1, 2, 3, that will be this month as well, and to see how they are doing now in the market. Are they on the low side? Are they on the high side? Should I invest more in them, and so forth? So, and then strategically invest so that you can boost the month that your dividend income is low, if that makes sense. So that's when you might have to, when you go through your list and find some stocks that are on the low side, then you might have to, put them on the side to compare them and see, okay, how much dividend are they paying me? What month are they paying the dividend? And what is the price? Yes, the price is close to 52 weeks low for all of them, but how much it is? Because if one is charging you $56, for instance, I don't have the price here, but that's just an example, and another one is costing you $23, and you have $100 to invest, you'll buy more of the $23 than you'll buy more of the $56. And then when you look at the dividend they are paying, and they both are paying you dividend in that same month of the quarter, and one is paying you higher dividend than the other, and you look at their chart, and their chart is good, then you might probably prioritize the 6% one because you can even buy more of that and so forth. There are some decisions you'll be making constantly as to which one to invest your next money in and so forth. So yeah, and that's that. So and I think we covered that. But how many shares to purchase for reinvest a dividend to purchase at least 1 share of stock? So yeah, that's another criteria. So when you are choosing to buy to invest in a stock, you can ask yourself, so how much of these shares should I buy if you have the money for it, so that next time they pay dividend, it can buy me 1 share of that dividend. So if the stock is selling for $10 and they are paying $25 a share, the number of shares, so that will be, you'll take that $10 divided by the amount they are paying per share, and that will give you 40. Now you know that if you have $400 to invest, maybe if that's a good company you like it, why not investing all of it there, so that next time they pay you and you reinvest that amount, it will buy you 1 share of that stocks. And keep in mind, the price changes. The price went up, then it might affect how many shares you'll buy. But that's one way as well to view it. Alternatively will be if you have 10 different stocks and you have 400 and they are all good to buy now, you might want to buy 1 share of each one of them so that you have them in your portfolio. That way later you can just go to your portfolio and see which one is on the low side that you want to buy more of and so forth. You can do that as well. So yeah, and we brush that one off. So pretty much, and we talk a little bit about account history. If you wanted to find those, if you wanted to see how much to track those income you are making, when you go to your Charles Schwab account, under account, you will click on history. So when you click on history, it will take you to your history. You make sure you have the right account selected, and you'll be able to see the dividend, the transaction that happened in your account, whether it was interest you earn, it was dividend from a stocks, and the dividend got reinvested. You will see those, and you can just manually update your spreadsheet next to each stocks for what you earn, or you can just go back to the top of the page and click on export. And when you click on export, you'll export it'll open a window. You'll click OK, and you'll be able to export that to your spreadsheet as a raw data. And when you add it to your spreadsheet, if you add some formula to your spreadsheet, you'll be able to automatically pull data from your download to your invest a dividend income spreadsheet to see how much each one of those stocks earn during the month for you. And when you are doing that, you'll just make sure, if you want to do it for every month, you want to make sure under date, once you click on it and choose previous month. That way at the end of the month, when you are in a new month, you download the previous month and so forth. That way you can just have all the month and data that will pull for you.
Do we put our church clothes on?
Yeah. Did you shower? Yeah, so thank you so much for watching. I'm Afiavi Liberman, creators of Liberman Consulting L.L.C. YouTube channel. and ninasoup.com, our blog, where you can find some free download to manage your money or to manage your business. We thank you very much, you all that watch our videos. We thank you for all your comments, and we thank you very much, you all that subscribe to our channel. We share different ways to save money and different ways to make money to reach your financial independence, where you do not depend on your employer to provide for your family. And investing in dividend stocks is one way to make money, to generate a stream of income where you put your money to work even while you are sleeping. So if you need to access those dividend income in difficult time, you have access to it. Thank you.